But Rana Gupta is with us, Senior Portfolio Manager, India Equity Specialist at Manulife Investment Management. Rana, great to have you with us here. Thank you very much. You know, it's rare to see what the RBI did on Friday, but we've had, you go back last 2 decades, instances where, you know, authorities have tried to pump prime a little bit at the margin, push growth really hard. From a monetary perspective, Rana, beyond the near-term sort of moves that we will see, some sentiment-led, some justified, etc., will this make a real difference to boosting growth, boosting demand on the ground? And what would you take a call on a more durable basis beyond the first 2-3 days?
Sure. Good morning and thanks for having me. So, no, it should. You know, there is this old saying that don't fight the central banks. I think that's true for the markets as well as the real economy. I think given the liquidity boost that has come, or the rate cuts that have come, and the liquidity boost that's going to come throughout the year, in that way you can call it a bit of a forward guidance on the liquidity because the other cuts will phase in. I think the banks, the lenders, they will be now kind of going out and lend. In fact, we met some of the bank and the non-banks. They were still not very bullish on the deposit and loan growth, but I think this policy is significant and it changes things a bit. And it has been our call that tax cut plus monetary policy will be supportive. And I think the pro-cyclical monetary policy that has come, that will go a long way to boost liquidity, cut rates, increase deposit and lending growth, as well as boost demand on the ground.
Rana, great to have you on this morning. Very, very strong morning for the bulls, right? Because they've finally broken out of a 17-day trading range. It's been a long period of consolidation for the index. Market as a whole, now that we've got this, turbocharged move from the RBI, anyway, the income tax rate cuts have come in. Some are expecting that even maybe on GST, we could see a relief next month. What lies ahead? What is the approach that you would take to this market, say, for the next at least 6 months? Mid caps versus small caps, what part of the market to buy? Because we're again at very close to all-time highs now.
Sure. I mean, we are getting close to all-time highs, but we were at these levels in September last year. In fact, now 9 months, the market has not gone much or anywhere. I think that being said, I think it's very important for us to get the sectors right. And within the sector, we can look at stocks across the market cap given the risk-reward framework. I think the supplier of credit, like the banks and the non-banks, they will benefit as the credit growth picks up. The banks, the margin contraction that was earlier thought will be lower than that because of the CRR cut that's going to come in the H2 of this year. Non-banks, I think we'll see the margin expanding and growth, so that's all positive. We have been also bullish on the financial services companies like brokers, asset managers, distributors, wealth managers. So I think all this in a very good spot. On the other hand, I think the user of credit, they will also benefit, and they can broadly put in 2 buckets. One is consumer, and one can think about auto, retail, and travel. These are typically levered consumption that should do well. Also, I think one should be bullish on the infrastructure stocks. Now, infrastructure, I don't mean the construction companies or the capital goods companies. I simply mean companies who own all the infrastructures. It could be companies like telecom companies, hospital companies, hotel, it can be oil and gas, can be power and real estate. Those infrastructure companies who have large asset bases, they tend to benefit because of better top-line growth. Their interest costs come down because many times these are very levered entities. Also, what happens is that their valuation improves as the rates fall down because they are long duration businesses. So I think we would focus on these sectors and across market cap ranges.
All right. Hi, Rana. Good morning. Good to see you. When you mentioned asset managers, distributors, wealth managers as well, but exchanges were left out. Do you think that they've got too expensive? BSE has been running on steroids. MCX as well, similar is the case. And IEX, after get bombed out, that stock as well has moved quite well. So the listed stocks are doing well. And in the unlisted space, NCX is doing a number of its own. You're interested in stock exchanges or not?
I think it depends on the investor risk reward profile. See, exchanges are probably the highest beta play on the volumes and liquidity in the exchange, as compared to that in I think a distributor or a wealth manager or insurance. You get a more diversified play with multiple earning drivers. So therefore, it's our preference to buy companies with diversified revenue streams. That being said, I think the exchanges remain the high beta play, and they may continue to do well. But I think the risk reward from our framework is better in the distributor companies like insurance or wealth managers.
Okay, it's, that's a point taken. By the way, lots of new stuff is coming up, right? I mean, AB Capital, if you can pull it up, is up 3.5%, and 242 on AB Capital. These are smaller names. Jana Small Finance Bank is up about 4% right now. Again, coming up with decent kind of gains. Fusion, I think on Friday did very well. It's up another 4% or so. You've got, lots of stuff. So 1,800 names are higher and about 600 stocks are lower at this point in time. Rana, the other point is, and this is, I guess you'd broadly agree, but the question is what to do. New ideas, hard to come by, right? It's a very finely priced market, 22 at a headline level, 22, 23 times earnings, P multiple. So you got to find newer things. It is hard, isn't it, Rana? So where exactly are you looking if you kind of sort of, spread out the canvas away from just financials and capital market plays, etc.?
I think so. Away from financial capital markets, first of all, I don't think the financials valuation, of course, barring exchanges, the financials valuations are not that high. So I think financials valuation was do okay. And if you look at the stock sectors that we discussed, the consumer sector has been one of the more expensive sectors in India. And we are comfortable with that because, the retail companies, the travel companies, they are growing at a much faster rate. Still, the valuation is compared to much slower growing consumer staples kind of companies. So we are also taking a bit of a relative call there as well. And aviation is, of course, another play on the travel spend, and that's valuation is reasonable. But outside that, the other broad sector that I said, which is like, telecom, hospitals, power, real estate, there the valuations are actually quite reasonable. So I think as the dust settles, as people figure out where the most benefit they see, I think with economic growth, their top line is going to grow, their interest cost is going to come down, and their valuation would improve. Real estate is also one sector. I think real estate power sector would highlight within infrastructure, where I think both you get good top line action as well as comfortable valuation. And maybe I just quickly also add to that, that I think you will see over a period of time, next 6 months, quite a bit of supply in the stock market from these kind of sectors. So I think that should ease the valuation a bit and also give us more choices.
Okay, fair enough. So power generation is what you mean, Rana?
I mean, particularly on the renewable power side, because renewable power, the growth story is very good. And if you look at the way the bidding is structured, the price is sort of fixed or levelized, and so that the developer could retain that benefit of all the prices going down. So let's say the solar cell price goes down, the interest costs go down, interest rates go down, that benefit they can retain. So future auctions will become even more competitive, but someone who has already won those bids will stand to make more profits than earlier thought.
So just as an example, what kind of names, Rana? Just purely for illustration purposes.
I would say that even in utility, look at the companies who are already won significant renewable bids. Those companies are something that we would be quite bullish on.
Okay, and the others you said is so there is power. You said real estate and hospitals as well. And any preferences in the other in real estate and hospitals? Anything or broadly? I mean, all okay.
I think real estate so far we have been running with so far we have been bullish on the company which owns the land bank to a large extent and debt free, but that's because the view on the cycle was tentative But with interest rate cuts and all that liquidity coming in, the confidence of cycle is improving again. And now I think it's a time to even go for some smaller, mid-cap kind of real estate companies also, where they have taken debt to build up a income stream. For example, let's say a commercial or office stream, because commercial office properties will do well. On the other hand, interest costs will go down. So I think look for companies which has significant commercial or hotel revenues as a part of their NAV. I think we see some benefit of the rate cuts.
Okay, very quickly, Rana, before we let you go, your view on metals and particularly the non-ferrous space. Silver prices are perked up all of a sudden. You have a special situation playing out in Vedanta. Though things are a little bit jittery as well because of President Trump. Don't know what he's going to do next.
So exactly, let me pick up the answer from your last line. We don't know what he's going to do next. But we know Indian policymakers are doing whatever they can to revive growth, and we don't want to fight that. So my views on metals are not even important. We will put money where we see more clarity, and that is typically Indian domestic cyclicals and rate sensitives.
Thanks, Rana, for joining in and filling us in with your take on the markets as well as individual sectors that we discussed.